Today we're going to talk about how to best weather a market downturn. Long-term investors will experience a number of market downturns over the course of their lives, which can be triggered by everything from natural disasters to political events. So if you're investing for retirement or another long-term financial goal, you need to know how to weather a market correction without throwing your financial plan completely off track. There are different types of downturns that we can experience, and you'll hear different terms used to describe them. So let's first talk about the variety of terminology used to describe these various market downturns that will occur over time. The first one is a pullback or a dip, which describes when you have a drop in average stock prices of at least 5% and less than 10%, and then a drop of at least 10% but less than 20% is going to be referred to as a correction, and a drop of 20% or more is what is referred to as a crash. Once prices return to the most recent high, the market is said to have recovered. On average, crashes will take longer to recover from than a correction, as they've lost more money in a crash. As an investor, you can't know for certain that a correction isn't a crash until it's over. For example, if stock prices drop by 14%, the trend could reverse from there and return the market to its previous high. On the other hand, prices could continue to fall, eventually dropping by 20%, resulting in a crash. So how should you invest during a market downturn? The stock markets are notoriously difficult to predict, which is why market timing is generally a bad idea. For example, it might sound great to pull your money out at the top when you're taking profits and then reinvest at the bottom, the basics of buy low, sell high. But the question becomes, when will those events occur? Historically, the best thing to do during a downturn has been to sit tight and ride it out. And that's because historically, corrections have always been followed by recoveries. And you can only benefit from that recovery if you hold on to your investments. We certainly acknowledge that keeping cool and riding it out is much easier said than done. So at times it can be helpful to tune out the endless market coverage that you hear, which can fuel some anxiety and lead to possibly making some poor decisions. If market downturns make you nervous, then that is a great time to reach out to your financial advisor. We as advisors can offer a third-party perspective, remove from the emotions, and help put things into historical perspective and make certain that what you do are aligned with your goals. If seeing your assets go into the red is truly causing you stress, you might actually have a lower risk tolerance than you originally thought. We can help you reassess your asset allocation and potentially tweak it to better fit your needs and your comfort level. One way we help clients is by setting realistic expectations. The market downturns are an unavoidable fact of long-term investing, so you need to expect these to occur. But also note that a sound financial plan takes them into account. We know it's not all upside. If you've already got an investment plan that reflects your unique situation, then the best thing to do during a downturn, based on the historical performance of the stock market, is to remain committed to your plan, knowing that downturns are accounted for within it.